My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to a special West Coast edition of Mad Money. Welcome to Cramerica. To be one of my friends, I'm just trying to help you save some money. My job is not just to teach, but to entertain, educate, and put it all in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Nasty week. Miserable week. Capped off by a terrible consumer price index number that makes you feel inflation so hot, the Fed better hit us with an emergency rate hike on Monday. Not even wait until Wednesday's federal meeting. I know that won't happen, but we do need a bigger hike than the Fed is currently considering. After the CPI figure, Fed Chief Jay Powell needs to shelve his plan for 50 basis point hikes and hit us with a 100 basis point hike to shock the system. Yes, inflation's so awful that the Dow correctly plunged another 880 points, while the S&P plummeted 2.91% and the NASDAQ nosedived 3.5%. Sell, sell, sell! Sure, maybe we catch a geopolitical break, like a surprise end to the war in Ukraine, but don't hold your breath. Maybe China drops its draconian lockdown policy, again, unlikely. Maybe President Biden can convince American oil companies to boost their production, but he doesn't seem to be trying very hard. For the moment, you have to accept radical acceptance. That's right, adopt a policy of radical acceptance. Radical acceptance of these negatives. Steel yourself this awful moment. We will get through this together. That said, there will come a time when we start baking in these red-hot inflation numbers. They do burn out, but only if the Fed keeps taking rates higher. And once we do that, we'll no longer have such a visceral reaction to every analyst price target, cut, or downgrade. By that point, we're going to be used to it, and you're to it. Wouldn't shock me if today's meltdown was one of the last straws. We need a bottom in price target cuts and a top in interest rates. We are going to get there, people. I just can't tell you when. In the meantime, you need to know that the companies out here in San Francisco have only just begun to realize that they overexpanded. And in many cases, some of these companies should never come public. They just couldn't resist the temptation because there was so much money in the system. Look, I say it's just beginning, because many of the valuations kicking around for privately held startups that I looked into this week are so wildly high versus their public brethren that a less diplomatic person might just say, stop lying to yourselves. Your company may not even be a company. Your company just may be a concept which you ginned up, and the VCs and bankers bought into it and made fortunes fooling the poor, unwashed public. But for now, VCs, but for now, companies, but for now, investment bankers, we're sick and tired of your pipe dream stocks. Nobody ever says this stuff because they care about making friends. I'm perfectly willing not to do that. Again, there needs to be what I call radical acceptance out here. Radical acceptance, and I'm going to keep using the term, that the stocks of companies with what I consider to be made-up financials that set adjusted EBITDA nonsense should simply go back to the drawing board. I'm not talking about tough love here. I'm talking about tough truth, especially for the most bogus companies that were invented in the last 3 years. I say they should never come public, but in many cases, they shouldn't even exist. Harsh? Maybe, but I'm trying to help you preserve your capital because a product is not a company. That was something I discovered in this trip, beyond the shadow of a doubt. That's just really killing us. Look, I have been on both sides of this business in my years on Wall Street. I've worked at Goldman Sachs. In the dot-com era, I actually brought a company public that I admitted repeatedly was overvalued and was concerned that the public market was just way too bullish about it. I was told by people bigger and better than I am that I ought to shut my mouth, but I wouldn't. Go read all about it in Confessions of a Street Act. I was never afraid to tell the truth about overvaluation, and I'm not afraid now. It doesn't end well. And with that note of levity, let's go to the game plan for next week. On Monday, Oracle speaks, and this might be the chance. We don't know. Chance to clear the air of tech disappointment, which just hangs over here. It's a stench, frankly. It's not an air. The software company can talk about how cheap its stock is, how well its acquisition of Cerner is going, and all the new clients they'll get. I expect that. I expect a tour de force conference call led by stalwart, implacable Safra Catz. Now, she's the CEO. If Oracle goes down after that, We know tech is sunk, and the depths are not yet plumbed. I think it'll be great, and if it doesn't matter, there could be more pain ahead. Tuesday, Affirm Holdings has an analyst meeting. I've warned you away from the stock, but I have tremendous faith in the company. However, the Wall Street Journal has questioned the bad loans from the buy now, pay later business that they have. That piece is devastating for the whole industry, but I think Affirm's better than its peers. Still, we find out who's right at that meeting. I'd like to bet with Affirm, but that doesn't mean I'm betting with a stock. DuPont's hosting an analyst meeting on Tuesday, too. I think straight-shooting CEO Ed Breen can clear out the miasma of disappointment we've been living in. Ed tells it like it is. That's one of the reasons why I like him and DuPont so much. At some point, he'll be asked if he sees a recession coming. That's what everybody does. We have lots of hedge fund managers come on who are trying to talk their book, pontificating about how the economy's terrible because of inflation. Fed Chief Powell has done a bad job. Ed doesn't care about that stuff. Ed just doesn't talk like that. But if he says we're going into recession, I want to know how long. Because at that point, if Ed says it, it is inevitable. Wednesday is the most important day of the week because it's when we'll learn the Fed's next move on interest rates. Will they stick with the 50 basis point increases that they've been telegraphing for the past few months? Or will today's hot CPI reading force them to act more aggressively like I want them to? And if they do act more aggressively, will the market welcome that news or will we get another sell-off? We'll have to wait and see. But, you know, if I think we get 100 basis points, initial reaction, bad. Secondary reaction, good. Thursday, a Transform Kroger reports, and it's anything like last time. You're going to hear a very compelling story about how a supermarket can localize, premiumize, and then win over its rivals. Kroger has employed every bit of relevant technology. You know what? I keep hearing about them out here. It's amazing. In order to transform itself, there's so much inflation in the grocery aisle that maybe it can't run ahead of the pain. But I'd still bet with these guys, not against them. I just wish the stock weren't so high. After the close, Adobe reports. We heard from them this week. I think it's going to be great, but no one will care unless bond yields go down that day or gasoline stays flat. Adobe's a terrific long-term growth story, though. So if it gets hit, you actually might want to buy some on weakness, but don't count it to turn around anytime soon. Leave more room to buy more. As you know, I run a charitable trust as part of the CNBC Investing Club, and I have to admit, today was brutal. So was yesterday. On really ugly days like this, you know what I do? I prefer to buy, not sell, particularly with the market being oversold. Today, I debated buying some Honeywell for the Charitable Trust ahead of its analyst meeting next Thursday, focused on the company's sustainable building business. That's an underappreciated story within Honeywell. But the company does have some economic sensitivity, and right now, well, that is just the kiss of death. So I'll keep my charitable bat on my shoulder unless Honeywell comes down, and then we see the stock plummet, say, one of these days. Could be worth picking up. Let's monitor it. If you belong to the club, you'll be kept up about whether to pull the trigger. Finally, on Friday, Centene has an analyst meeting, and I want to hear about whether the company's continuing the tradition of the late Michael Neidorff, the man who created this healthcare powerhouse. Michael was one of the greatest people whom I've had the privilege of meeting since starting the show. All I can say is when the camera stopped, he talked not of business, but of charity, of compassion, and always how my kid's doing. So the bottom line, next week can be a continuation of this week unless we get a break in China, Ukraine, or at the pump, or the Fed does something big. You'd think that we'd be used to all the negatives that we keep getting by now, but we aren't. And it'll be very hard to have a real bottom until some of those things change. I want to take questions. I'd like to start with Eric in Tennessee. Eric.
Hey, Jim. Thanks for taking my call.
Oh, you're quite welcome.
My question for you is in regard to Waste Management, ticker WM. This company has historically been a growth through acquisition company, and through this model, they have become a world dominator in the area of waste disposal. This company's growth has slowed in recent years. However, Waste Management's margins have been very consistent, and the company has raised its dividends every year for the past 17 years in a row. With a PE of 34 and a price to book of 8, is this stock too expensive?
The problem is it is, and I have liked Waste for a long time. I think Jim Fisher's a remarkable manager, but we like to buy companies that make things and do stuff that return capital. That's so freaking good for Waste, but also sell at a reasonable price. And unfortunately, Waste no longer does in a market that's this unforgiving. Next week could be the continuation of this week, unless we get a break in China, Russia at the pump, or the Fed does something big. On Mad Money tonight, fresh off the company's analyst day, I'm breaking down all the headlines and product innovations with AMD's Lisa Su. Then DocuSign and Stitch Fix cratered today after earnings. So are these two stocks now compelling enough and cheap enough that you should buy them? I'll give you my take. And cybersecurity is still one of the most important cohorts that's still working that we heard from out here in San Francisco. So I'm sitting down with the CEO of CyberArk to see how his company's defending enterprises from an increase in cyber threats. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.